Can good news for the economy remain good news for stocks, even if it means yields go higher and stay there? Let's ask Adam Parker, Trivariate Research founder and CEO and a CNBC contributor, and Cheryl Young, Rockefeller Family Office private wealth advisor. Welcome to you both. Good to have you both here. So there's the setup, Adam. I mean, the soft landing scenario, you haven't seen much of anything to really disturb that. Market has been trying to make its peace with yields at these levels. I guess putting on a brave face. You have this rotation away from big tech. How does it feel to you?
I mean, my bias is that we can go higher over a few months. And, you know, the market's been remarkably resilient to some pretty extreme politics and global risk. I think most people came in this year underallocated to U.S. equities, believing, you know, bond yields look more attractive, and they haven't fully participated in this rally. They didn't own a bunch of, you know, Tesla and NVIDIA Meta on Jan 3rd and hold it all the way through. And so I think there could be a pretty big chase. I don't believe that good news is bad for the market for a sustained period. It can happen briefly when people get worried. But basically, good news is good news. And answering the question in your teaser, there's lots of evidence historically that the stock market can work when bond yields rise, because often they're both emblematic of better growth. Yeah. So I think that the risk reward skewed to the positive, at least, you know, through earnings here.
Cheryl, I mentioned, you know, the good news that we got evidence of this morning was largely the retail sales coming in very strong. Even industrial production was okay. At the same time, Fed officials have been out there saying, okay, we're not going to necessarily look to do a whole lot more from here. Is that a green light for stocks, or do we still have to say, you know, how long can this growth last? How long can the economy withstand higher yields?
Look, I think this is a market where you have to be very picky in terms of what you own, because there are green lights on some sectors and some stocks. But I wouldn't be excited about the overall markets at this point. I look back at this COVID hangover effect I think we've had. And when I look at people I know, they are traveling, eating out, despite the higher costs. And so the feds are saying, hey, we have to get inflation under control. But people are saying, I don't care how much I'm spending, I'm going to go on these trips. Consumer credit card debt passed $1 trillion, highest level we've ever seen. Savings rates have been cut in half in the last year. I look at the markets and say, how can people keep spending? And the retail numbers this morning were phenomenal, but that actually concerns me a little bit.
Yeah, I mean, they're spending, look, it's like a 3.8% annualized growth rate in retail spending. That's about what wages are up. Right? That's a nominal number. So it's strong relative to what we were expecting. But I guess it's really this tricky point where you say, is it sustainable? Is it, are we going to kind of fall off quickly in terms of activity? You know,
I don't think we're going to fall off quickly.
Yeah.
I think if I gave anyone a project, tell me what the U.S. consumer's condition is. And I said, ingest any data you want, whether you look at wages and jobs, which really multiplied by each other are the revenue in this analog. And they're still pretty good. Yeah. Right? You can talk about saving, sure, other stimulus. You can talk about 90-day credit card delinquency. No matter what I tell you to do, you're going to say the consumer's in good shape in absolute terms, but it's getting a little bit worse. Right. So the market can work in that scenario if it really is a sustained Goldilocks, which is people think they're done hiking or there's one more. We're certainly on the other side of that cycle, and earnings don't collapse. And that's what I think is going on, at least for the next few months.
There was some interesting commentary. Richmond Fed President, I believe it was, Barkin today, and he Cheryl, got at your point about this sort of willingness to spend more. And he's basically saying one thing we didn't bargain for is, you know, there's a cohort of relatively wealthy investors. They own stocks. You know, they saved a lot. They didn't spend a lot down. They have a lot of home equity, and they're out there being pretty aggressive with it. It also pairs with this idea that older Americans are spending pretty heavily, 65 and over. They're traveling and doing whatever. And I just wonder if that changes the Fed equation or puts them on more of an alert for we may have to do more, or is it just going to be about inflation?
Yeah, I think we might have one rate hike ahead of us. I don't think it's going to happen at the end of October, but maybe 50% chance December or January it could happen. Yeah. And I think Feds could keep rates longer at a higher level than we originally had thought. But to Adam's point, there are still a lot of healthy things in this economy that I'm excited about, and you have to look at where the opportunities are and be maybe willing to sit in a sideways market and be patient. Which works really well for options, which is a lot of what I do.
Oh, is that right? Yeah.
It's
for selling them.
I sell calls, I buy puts.
Okay.
On a day like today where we've had these massive swings, it's been really fun.
Yeah, that's right.